Hey everyone, this is Tyler from MacroOps, and we're back with the Market SitReps. This one's called If You Can't Beat 'em, Join 'em. All right, so we're going to get into the U.S. equity market breakout. That's obviously the most interesting thing happening in the markets right now since the Brexit. And then we're going to check out a couple of breakout stocks that we are watching, some of which we're already long, some we're waiting to get long, and others that we're just kind of monitoring. They're very overextended, and we might get long them down the line. So let's get into it. So first off, we feel like there's three components to this fuel behind this market rally, and it's the typical late cycle sentiment, the equity risk premium, and finally China's massive QE. So what we mean by late cycle sentiment is that bears have been getting absolutely killed in US equities. All right, there's been no way a bear can make money in the markets. They've been scraped, scathed, scarred in every way possible. And some bears were up a lot of money in the beginning of January, and then the market just absolutely ripped to the upside, dashed all their hopes again. And so they're having a big problem now because the fund managers that have been short can't stay in business. They need to produce returns for clients to avoid redemptions. And investors are fickle. They only wait for so long with 0% returns, flat returns, or negative returns before they pull the money. Investors don't have long-term conviction in a process. That's just not how it works. They always performance chase no matter what, because they don't have that conviction that the hedge fund manager or the investment manager has, because they've been through the long term. They've been through the ups and downs. The investors, a lot of them haven't been through that, so they can pull really easily. And right now, buying's the only way to make money. All right, it's been the only way to make money in the markets. Bonds have been going up, stocks can't sell off. There's been a lot of people making money buying oil, buying junk debt at the lows, buying gold, etc. So longs are the only people getting paid, and to stay in business, that's what these fund managers are forced to do, especially in late cycle. It's when almost all the bears have been taken out of business. And so the primary emotion that we feel is going on in the markets is FOMO, fear of missing out. And if you're unfamiliar with this term, it's the state of mental or emotional strain caused by the fear of missing out, a compulsive concern that one might miss an opportunity or satisfying event. And so all these guys know if the market breaks out and goes on a run and they're not in it, they're losing their business. All right, it's going to go to a passive robo-advisor. It's going to go to a guy that's just always long, a perma-bull. Many managers that really respect downside risk and are shooting for long-term risk-adjusted returns, they know this is a reality at this point. Okay, they have to somehow participate in the upside, or they're going to get investor redemptions. Now, the second component we feel like that's driving this market is more mathy, more quantity, and it's the equity risk premium. So the ERP is the difference in the risk premium spread between assets, most notably 10-year treasuries and the equity markets. Okay, so what this means is that equities yield X% and 10-year treasuries yield Y%. And depending on the width of that spread, people are going to be more likely to buy equities or buy treasuries. So right now, when you have equities yielding much more than a 10-year treasury, because we're at extremely low rates globally, it gives a large incentive for investors to pile into equities to realize some of that yield. And this falling rates around the world continue to make equities the only game in town. So we've been on the ZERP and NERP theme this entire year, and the US is near all-time lows for their yields as well on their fixed income. So that is why we're seeing just such a plowing of money into equities. As the yield on the long bond continues to move lower, this risk premium on equities widens. Okay, like I mentioned before, so if equities are yielding, for example, 4% and bonds are yielding 2%, and then bonds go down to 1%, that spread changed from 2 to 3%, which makes equities much more attractive. So it's sort of interesting because the higher the price the bond trades at, the more attractive the equities look. So then people start to buy those and they move up as well. So the entire correlation of stock market up, bonds down, bonds up, stock market down is completely breaking down at this point just because of this ZERP NERP environment. And the US long bond yields continue to drive lower every day because of the global relative value trade. And yes, the US is still the world's cleanest dirty shirt, and that's why we're seeing people pile into US bonds. And you can't get anything in Japanese bonds. You can't get anything in European bonds anymore. No one really wants to screw around with emerging markets right now because it's not risk on, everything's happy. There's still a lot of overhanging concerns, so it makes a lot of sense that U.S. long bonds get bid up heavily when you get volatility events like Brexit. You can see here this graph from Deutsche Bank showing the different contributions to the SPX rally in current versus past cycles. So you can see on the left in the 83 to 90 range is mostly earnings growth. And then same thing with 96 to 2000, it was earnings growth again, with some ERP compression. And then 2003 to 2007, the ERP compression, it was actually a negative contributor, and it was primarily all earnings growth. And then now we're seeing in 2012, 2016, it's multiple expansion, primarily ERP compression, and earnings growth is actually a negative contribution because earnings has been stalling out for the S&P 500. So this equity risk premium has been a big driver in the recent rally in stock market. And now the third thing is China's massive QE. We don't hear as much about China's massive QE because it's deployed in a little bit of a stealth manner. It's not as widely covered by the financial media, but they've been conducting a massive hidden QE the last 6 months through their repo markets. And this is likely having a large impact on commodity demand and boosting some emerging markets. And we can see that a lot of the commodities have been running this year. And right now we got steel running, and some of the more industrial commodities are starting to run again. And this is due to China's huge stimulus. And here's a great little note from Crescat Capital. The PBOC has injected over $1.6 trillion of cash to the Chinese markets this year through the repo market. This intervention, net of foreign reserve changes, is approximately $2.8 trillion annualized, or about 26% of its nominal GDP. This annualized net level of QE is beyond any other major central bank stimulus program today. It exceeds both that of the European Central Bank and the Bank of Japan. So if you look at this graph right here, basically Crescat's saying that the 2016 year-to-date June annualized QE as a percentage of GDP is highest in China. All right, so we hear about the big stimulus programs coming out of Japan. We hear about the big stimulus programs coming out of the European Central Bank, but it's actually China who's contributing the most. And now, since we've had all these three components that have driven the market up, do we still have more gas in the tank? Is there a possibility of a continued blow-off rally? And it's looking like that answer is yes. So one thing we really like to watch is liquidity conditions. And junk debt sold out big time at the beginning of the 2016, and now it's come back and held its rally very nicely. And that's a big tell for upside in U.S. equities. And you can see here to the right, high yield spreads and high yield energy, and then high yield X energy and metals. The high yield energy space has come off quite a bit. So there was a huge scare at the end of 2015 and 2016. People were going bankrupt, loans were going bad. And now you can see since that initial sell-off in the beginning of the year, we've gone straight down in the spread. So that's a huge benefit for the market when liquidity conditions are improving. Another thing that's pretty interesting is that leads us to believe there could be more gas in the tank is the household debt service ratio. So if you look on the right, household debt service ratio in the U.S. is low compared to past cycles. So look before 2008, you could see in fourth quarter 2007, debt payments as a percent of disposable personal income in the U.S. was around 13.2%. And it's actually dropped off quite a bit since the financial crisis, down to 10.0%. So it's pretty interesting. Despite all the QE, despite all the lower for longer rates, households aren't as leveraged. They're not taking out as much debt as a percentage of their disposable personal income. So if they decide to do that again, we could have another somewhat of a sustained cycle as that number creeps back up towards something that's, maybe around 11 or 12%. So that's another metric here that could possibly lead us to a year or multi-year run. And now let's look at a snapshot of prior tops. This is a cool graph from JP Morgan that looks at March 2000, October 2007, and now, and we see the price, the PE ratio, the dividend yield, and the 10-year treasury. So you can see right now we're at a 16.6x PE ratio, which is much lower than the top in 2000, but right around the same as the one in 2007. So that right there in itself isn't that compelling, but it still says yes, we can run. There is precedent for the multiple to expand, and we can run. The dividend yield is much stronger than it was in the past two tops, and especially when we compare it to the 10-year treasury. And this is where we talk about that ERP, equity risk premium concept. see in March 2000, 6.2% of the 10-year Treasury compared to a 1.1% dividend yield in the S&P. So 10-year, it's still pretty attractive compared to the equity market there. Same thing in 2007. There's a positive spread. Now we have a negative spread, so the 10-year is not yielding nearly as much as the equity market. So as a pure yield play, you can see a lot of guys saying, hey, I can buy a 10-year Treasury for 1.5, or I can buy the S&P at a 2.3% here and just hold, and I'll make a little bit of more money. And then we're really seeing that type of psychology and that type of internal narrative play out and causing people to continue to buy. And here's a more in-depth analysis of the multiples. And this looks at where we're at now, the 25-year average and the standard deviation over undervalued. And you can see it's not that off the charts. So it doesn't scream either way whether we should fall or go up. But you can see the latest just general forward PE at 16.6, 25-year average of 15.9. Now, averages can be a little tricky to interpret because they get really screwed up by extreme readings. But if you look at the graph, it's not, 16.6 is not terribly overvalued or undervalued. It's sort of right in the middle of this graph that goes back to 1990. Then Shiller's PE, we are at, and a lot of quants like to use the Shiller's PE as a long-term indication of value because it adjusts 10 years back. And it has a reading of 26 now, and the 25-year average is 25.8. So again, kind of right there near the average. And that average was skewed during the 99 bubble, but nothing much compelling there. Dividend yield sort of right around average. Price to book, pretty around the 25-year average. Price to cash flow, similar. And then the earnings yield minus the BAA yield, that's again equity risk premium. You can see it's positive now, like we talked about on the last slide, versus 25-year average was negative. So if you look at these metrics, you can see how a lot of fund managers say, this doesn't look that bearish at all, and they think the market can continue to climb here. Now, we can't discount the fact that we still have all these debt problems, and the business cycle is long in the tooth, and we've never really been in these financial conditions before. So you never just want to take a look at one thing and say, hey, this means I want to buy, or this means I want to sell. But looking at the multiples here, there's not a really compelling argument that the market should crash or the market should rally really hard. But you could see why people justified buying here, because it's not like the readings are off the charts high yet. And so how to play the long side? How are we looking at the long side? Well, we like commodity stocks. That sector's been sold off big time, and now they're all coming back and ripping. And we like tech and healthcare if we're going to go on to a risk on cycle. So those are the things we're looking at. Also, commodity-dependent emerging markets should run pretty hard too. If commodity prices are starting to rally, emerging markets primarily rely on commodities to make their money. So those stock markets should rally as well. And now we're going to go take a look at a few charts on a charting platform here and go through a bunch of tickers that we're looking at. All right, so the first chart I want to go through is the S&P 100 index, and we can see a very decisive breakout has occurred with some follow through as well. So that's one feather in the cap for the bulls, and this is a pretty large congestion pattern that we're breaking out of. So you would think that if the market's breaking out of this big of a congestion pattern, there would be some room to run here. So technically speaking, the market looks very, very strong. Now, we didn't buy the index yet, but we're just using this as kind of a thermometer for how bullish things can get. Now, if we go over to China, we can see that the China A-share ETF is just peeking its head out of a wedge formation here. And we're looking at this, we're really looking to get long China. We think it can have another blow-off run, especially if they're simulating hard, and just retrace and maybe run up to this 35 area. So that's definitely something that we're going to be convicted on if we can get over somewhere along these highs here. So we had this initial breakout, it came off a bit, but if we can get some strength back up over this level at the 25.20, then we'll be very interested in taking this long. Next is EPU, the Peru capped ETF, and we talked about how emerging markets commodity, or they rely on a lot of their income for commodities, and that's why we got attracted to this one. And we had a nice little cup right here with a very tightly compacted handle, a nice long multi-week handle with the breakout. So we got long this on the breakout back around 31.16, and we're looking to hold this for as long as we can. This could definitely run if commodities continue to run, and we can see some more strength in the US markets as well. Now here's our first individual stock we're going to look at. This is a new IPO, ACIA. And basically they're an internet infrastructure company. And you can see they IPO'd back in around May 13th. And they had a huge run up consolidation, and now we're just blasting to all-time highs. So this is one we're definitely going to look at. There's an entry on this breakout right here, or you could wait for a pullback. But if we have a risk-on period, these more speculative companies like this that have extremely high growth potential can run a lot. All right, this thing could easily run up to 68, 70 plus off of just pure euphoria. Now, EBIX is a SaaS company, software as a service for the insurance industry. Very hot right now. It's obviously ran up a lot. And let me just segue into how we're initially finding these stocks right now. So we look at momentum, and we have a couple of proprietary screeners we use to evaluate relative momentum across the entire market. And we find stocks that have the most momentum, and then we look and see if we can find a smoothness in the price action for some good risk to reward entries. So that's how we're getting a lot of these names to come up. It's through our quantitative momentum scan. And then we dig into the fundamentals a little bit. We also dig into the chart pattern to see if there's any clarity there. So that's how we're getting a lot of these stocks. But anyway, back to EBIX, you could see a nice little breakout out of this tight congestion. And if we have a risk on rally in the markets, that could run up, easily near 60, possibly higher as well. CLF, that's another commodity play. We got long this after it broke out of this little handle in the cup and handle formation. Obviously, it's just ripped everyone's face off here to the upside. And CLF, it's had quite a down move in the past. It's a natural resources stock. This was a hated sector. Now it's coming back as commodities rally. So this has huge potential. I mean, you could see back in 2013, 2012, this was a $50 stock. It's at $7 right now. So just a lot of upside potential. These resource stocks really get us excited down here at these levels, kind of dumpster diving for huge gains to the upside. X, same thing. It's a steel play. It's a commodity resource play. Had a great breakout of this ascending triangle. This is a little overextended for us to enter right here. We're probably going to wait for a little more clarity or some type of pullback down. Entering right here is not that great of risk reward, but definitely something we want to watch. FONR, F-O-N-R. This is a metal equipment and supplier company, so we're also looking at healthcare. You can see this is absolutely ripped out of a nice multi-month descending triangle right here. A very clear breakout with a very nice run. At this point, it's overextended for us, so we're not in this stock. We're looking for a pullback. I think any hot medical equipment company is going to do very, very well in a risk-on environment, and FONR has a very high momentum score. Finally, another tech company that we're looking at is Meet Me Incorporated. It's a computer services and technology company, and they basically service the Latin American community. They're based out of the US, but they service Latin America, and this is another technology speculative company, something that can run a lot, and as you can see is already run a ton. Let's just take a look on a percentage basis. Since this breakout right here of this symmetrical triangle, we've already seen a 78% run. So these high momentum, high octane tech and healthcare stocks are can really run quick in a risk on environment. And that's why we look to capitalize on them. You can get 78% gains in such a short time. I mean, this happened in around 2 months. So the initial entry was here. We'd wait for a pullback and another consolidation and then hit this thing again. I mean, who knows how high this can go. You could see it was back in the past in 2011, it got up to 14. So it's not crazy to think that this thing could double yet again from here. Also, PayPal Holdings has earnings in 5 days, but we're really watching this. We're excited about this space, the payment processing space. It's definitely something that we see as a lot of upside in the future. And any break above this 40.39 area, we'd definitely be interested in getting long. PAAS is a silver miner, and obviously the gold miner, silver miner trade has been fantastic since the start of the year. If we just take a look at since the break from the lows, this thing's up 237%, absolutely insane run. It had a very, very nice breakout recently from this ascending triangle right here at 1629. We were already long silver futures, so we didn't take more risk in the silver miner space. But to add to our silver position, our long silver position, we're definitely interested in getting in some type of pullback. So keep these high momentum gold and silver miners on your watch list. There might be a little more extended now, but on any type of consolidation and pullback, it's going to be great to get long again. And finally, this is another healthcare company, LifeVantage Corp, LFVN. You can see a beautiful breakout of this inverted head and shoulders that occurred right around 5.9, and it's since run pretty well. We took a little bit of a position here on the breakout of this consolidation. We think it can run at least to 1862 and then 26 after that. So these are all the stocks that we are watching, and we feel like if we have that nice risk on rally, all these things in here are just going to pay out huge and rip to the upside. All right, before we wrap things up for this episode, I want to announce our new special report. We just released its 20-plus page report about option strategy and how we use options at MacroOps. And we call it options trading a sucker's game for most because we see so many people get lured into the options market and they think that it's going to allow them to get super high returns on super high leverage. They get all excited about all the different types of spreads and stuff that you can do with options, but the game is much harder than most people think. And you really need to have a deep understanding of implied volatility and volatility to be successful in the options market. So we write a lot about volatility in this special report. We also talk about how we think of options and how we use them. So you can go to our website, macro-ops.com, click on special reports, enter your email, and you'll get this downloaded a download link straight into your email inbox. And if you're watching this on YouTube, I'll put a link to that in the description down below. And thanks again for watching this week's Market SitRep. If you liked us, subscribe on YouTube or follow us on Twitter at MacroOps. We also have a Facebook group as well that you can join. We have a lot of interesting conversation in there. It's completely free to join. Or you can also follow us on StockTwits at Alex_. Or check out our website as well, macro-ops.com. Thanks for tuning in for this week's Market SitRep. I'll see you next time.